You are building a structure of wealth, but you are probably ignoring the very walls that keep it from collapsing. Many people believe building wealth is only about how much you earn and how fast your investments grow. They spend 20 years stacking brick after brick, believing they are safe. But the truth of the system is different. One single liability event, one unexpected health crisis, or one accident can sweep away 20 years of labor in a single afternoon. If you only focus on the roof, your investments, and ignore the walls, your protection, you are not building a fortress. You are building a house of cards. In this episode, we will unpack how the system actually operates, why insurance is not a drain on your returns, and how to build 5 load-bearing walls that make your wealth structure completely unbreakable. Let us start with the first wall, catastrophic health coverage. Healthcare is the leading cause of personal bankruptcy in the United States, driving nearly 66% of all filings. Think about that. You can eat healthy, work out, and do everything right, but a single medical emergency, like a severe appendicitis or an unexpected accident, can easily run a bill of over $120,000. Without proper walls, that bill destroys your life. But with a properly structured high-deductible health plan, your out-of-pocket maximum is legally capped. For our working example, let us say your annual out-of-pocket maximum is $3,000. Our cash foundation of $22,800, which is 6 months of essential expenses, can absorb that $3,000 hit more than 7 times over. That is a coverage ratio of 7.6. By raising your deductible, you lower your monthly premium, and your cash foundation stands ready to absorb the blow. You have effectively outsourced a $120,000 risk for a fraction of the cost, keeping your wealth structure intact. The second wall is pure term life insurance. This is only necessary if someone else relies on your income to survive, like a partner or your children. Do not make the mistake of buying whole life or universal life policies, which are often marketed as investments. They are a massive drain on your cash flow. Instead, buy pure term life. The target coverage should be 10 to 12 times your annual income. If your income is $60,000, your coverage target is $600,000 to $720,000. For a healthy 35-year-old, a 20-year term policy of this size costs only $25 to $40 per month. If something happens to you, this wall ensures your family's financial structure does not collapse. It replaces your income and allows them to pay off the mortgage, buy groceries, and maintain their standard of living without being forced to liquidate assets or go into debt. Now consider the third wall, long-term disability insurance. This is perhaps the most overlooked wall of all. Nearly 70% of private sector workers in the United States lack private long-term disability coverage outside of Social Security. Yet, during your working years, you are far more likely to experience a disability that prevents you from working than you are to pass away. If you lose your ability to earn, your cash foundation will run dry in 6 months, and your wealth building stops instantly. To build this wall, you need a policy that replaces 60% of your pre-tax income, paying you until age 65. For an income of $60,000, this translates to $3,000 per month of tax-free benefit. Ensure the policy is defined as own occupation, meaning it pays if you cannot perform the specific duties of your own job, not just any job. This wall protects your greatest wealth-generating asset, your ability to work and earn. The fourth wall consists of property and liability coverage. This protects your physical assets, like your home and your car, from physical damage, and, more importantly, from lawsuits. If you have a car accident that is your fault, or if someone slips and falls on your property, you can be held legally responsible for hundreds of thousands of dollars. If your liability limits are too low, your personal savings, investments, and even your future wages can be garnished to pay the judgment. To make this wall strong, your liability limits must be at least equal to your net worth, or a minimum of $300,000. Do not settle for the state-mandated minimums, which are often as low as $25,000. Raising your liability limits to $300,000 costs only a few extra dollars a month. And here is a system secret. If you raise your deductibles to $3,000, you can cut your auto and home insurance premiums by up to 40%. Use those savings to fund your higher limits. The fifth and final wall is the umbrella liability policy. This is the ultimate shield that sits on top of your auto and home policies. An umbrella policy only activates when your primary liability limits are completely exhausted. For example, if you are sued for $800,000 after a severe car accident and your auto liability cap is $300,000, your auto policy pays its limit and the umbrella policy kicks in to cover the remaining $500,000. Without this wall, your investments and home are exposed. An umbrella policy of $1 million is incredibly cheap, costing only $15 to $25 per month. It is cheap because it rarely gets used, but when it does, it saves you from complete financial ruin. If your net worth is growing, or if you have visible assets, this wall is non-negotiable. It stands between a catastrophic legal judgment and the wealth you spent decades building. Now that you understand the 5 walls, let us examine the 3 critical mistakes people make when constructing them. First, they underinsure major catastrophes while overinsuring minor maintenance events. They buy policies with low deductibles and low limits, paying high premiums to cover minor $500 repairs, while leaving themselves exposed to $1 million lawsuit. This is insuring the wallpaper instead of the walls. Second, they buy the wrong products, like whole life insurance, thinking they are investing while being severely underinsured on pure death benefits. Third, they allow their coverage to lapse or fail to update their limits as their net worth grows. A gap or a lapse is an open door for a crisis to enter. To prevent these failures, we must shift from a passive mindset of paying bills to an active system of managing risk. Your walls must be built deliberately, with exact numbers, and audited annually. This brings us to our wall check framework. Grab a notebook and write down these 5 actionable steps. First, write your 5 key numbers: your annual income, essential monthly expenses, cash foundation, net worth, and current liability limits. Second, audit your 5 protection walls against the targets we discussed. Third, calculate your coverage gap. If your net worth is $500,000, but your car liability limit is $50,000, you have a $250,000 gap. Fourth, price that single largest gap today. Call your broker and ask to raise your limits or add an umbrella policy. You will be surprised by how inexpensive it is. Fifth, schedule an annual and life cycle review to update your walls as your wealth grows. Take action today. Write down your numbers and secure your walls. Because in the next structure, we will show how the roof, your first real investments, finally goes up, now that the foundation and the walls can carry its full weight.